Right. So we had a circumstance, right, where gold was down 7 months in a row. And you can go back to the late 1800s and not find that. And then since then, actually, gold has had a tremendous recovery. Not only that, but gold miners, as measured by either the Philadelphia Gold and Silver Index or the New York Stock Exchange Gold Bugs Index, are now up 4 months in a row. There is no other aggregate that has done that. Not any S&P 500 sector or mid-cap sector, no other bourse, no commodity, no other aggregate of any kind. And so relative strength is important. We know that if you consider all the factors that go into some of the great quant models, momentum and relative strength are very robust. Whether you call the consolidation the end of a bull is not necessarily. I would characterize it as follows, that the great ascent, the decade from 2000 to 2010, plus or minus, has been, and the excess of that period has been worked off. And so in principle, after resting, you usually get resolved in the direction of the preceding move. So I would say it's a continuation of the bull, so to speak, or as you just characterized, a new bull. But the sell-off is minor, right, in the context of the preceding ascent. And so I would consider the entire past decade just a rest rather than a bear. Yeah, I mean, we're in the camp that dollar continues to go lower, but not much lower, to be fair. And we know that gold is making all-time highs in other currencies. Of course, there are many ways to look at that. So here's a chart of the dollar over the past 2.5 years where it's really been dynamic to the upside. No lines, no drawings, no judgments, no conclusions. Let's put some in. Take it away, put them back. We're almost down to the lower band, which comes into play at around 102, thereabouts. Now, at that point, we will be fairly oversold, and I'm thinking you'll get some stabilization in the dollar. If you look at this longer term, here's now going back to 1993, and put in lines like this. After breaking out from this well-defined thing, we've checked back to a level of support. Now, to be fair, support is not a plywood board or a concrete floor. It's a mattress top. And you sink into support before ultimately finding it. And so could the dollar move down, down into, again, as low as 100? Sure, but this sequence is not likely to go much lower before you get some stabilization. But independent of that, I don't think there's any reason that gold can't prosper and perform well. And certainly, to your point, relative to other things. Right, so there's a lag effect, as we know, to tightening, if you will. And so I think I'm in the camp. Look, there's so many, there's the stagflation camp now. There's the it was going to be transitory. Of course, that turns out not to be true. All of these things. You have to pick a side, pick a direction. And my view is that we've seen peaks in commodities. You're seeing the rollover there, and that obviously while labor is a big fact, labor and rents are still persistently high. Ultimately, there's a reason that 10-year yields aren't higher right now. It's because I think we have peaked. The thing about healthcare is it has offensive and defensive characteristics, right? And it's really, in many ways, the only sector that can claim that. So what we know is that defensive behavior, right out of page 1 or day 1 at business school, they say, when you're in trouble or the market's in trouble, you rotate into defensive type securities. And people still do that. The biggest mutual fund families and pension plans do. I talk to them all the time. And we know that you roll back the clock 100 years, there was no medicine. There was no medicine, right? There are guys walking around with jars of pills that meant nothing, snake oil salesmen. And there was no defensive characteristics, healthcare, right? I mean, when they cut your leg off in the Civil War, they gave you a drink, you bit down on the piece of wood, and they sawed your leg off. That's not medicine. That's horrific. Here's my point. True defensive is what's known as soap and cereal. That's what it was described in the 50s and the 40s. We have biscuit companies that are 250 years old. So think of Nabisco, literally, and Post Cereal and Kellogg and Kraft. And then soap is things like Colgate-Palmolive selling and Procter & Gamble. So there is only one true defensive, utilities notwithstanding, but truly defensive sector, which is consumer staples, soap and cereal. But we now have something else in the last 30 to 50 years that's also defensive, which is big pharmaceutical companies that have ongoing cash flow. And I want to look at healthcare because it is both defensive and offensive because you have a lot of biotech. You have devices, growth areas of healthcare like Intuitive Surgical, right? That create robots to do operation and so forth. So this chart right here is an all data chart of the S&P 500 healthcare sector on the top. And we're looking at relative performance to the S&P on the bottom. Let's put in some lines. Now look at this. Look at this trend line. Do we think that's random? And look, it's bounced off that. So this is so important for anyone who wants to spend time with charts.
Yeah.
Now one could say, how is that possible? Is it some trick? The healthcare sector, which is Johnson & Johnson, Amgen, and Merck, and Lilly, but also Humana, Managed Care, and United Healthcare, and Intuitive Surgical, and Stryker, and so forth. All these different biotech, and yet, why is it that the relative strength line stops and bounces to the penny? Do you think that's dividend discount model, price to sales, enterprise value to EBITDA, price? No, it's all technical. And the great quant models, they watch these lines. And where did healthcare bounce in 2021? To the penny. And what I think is about to happen here is that healthcare has been underperforming since 2015. I think it's going to make a new high, relative. And one could say, yeah, it hasn't come a long way. Okay, it's come up over the last year, but it's basically on a relative basis below where it was from 2015. This is still young in the making. Let me look at it another way. Now here is healthcare relative to what I said was classic defense, right? Staples, Procter, Colgate, Church & Dwight, right? Kellogg, so forth and so on. And look at the relative line.
Look at that.
Healthcare is only now back to where it was at the dot-com peak.
Wow.
So healthcare has been ascending and ascending and ascending, but it's only now back to its relative highs of 22 years ago to staples. And so let's put in some lines. A textbook setup for a breakout. And so there's no growth. Procter has no growth. Colgate has no growth, right? Coke has no growth. Pepsi has no growth. They're big tobacco, big sleepy businesses that have revenue growth of 2 and 3% a year that always trade rich, a higher multiple because they're safe. They are safe. People keep drinking Coke and keep smoking cigarettes or whatever else they're doing. Keep washing their clothes, brushing their teeth. But healthcare has the same defensive characteristics, but it's got the offensive. And so an ultimate pairs trade is being short consumer staples by my work and long healthcare.
Thanks.
Tesla is, look, I mean, I've reversed a short on that and I've got I think it's time to bet on the long side. We shall see. So no lines, no drawings. And what we have, and it's fairly straightforward, right, is the following. We are just down to the point where I think rebound potential is high. We have the same circumstance here on the top. Watch. I did from the high to here. It's the same thing, yes? So in the up phase, you stay within bounds. On the down phase, does it mean that Tesla can't go to 50? Go to 50, go to 0. But on a tactical basis, I'm a buyer for a bounce.
Okay.
Apple, not so good. I think Apple's good. Apple is so widely owned. It has all the elements of a major top. Don't like Apple.
You know, broader view, S&P overall, I've seen you in other interviews saying you could see some heavy selling at the start of this year. How come? Yep.
Gold, I think, remains number one of precious metals in general. And then within the market, equities, my hunch is to have healthcare as a sort of a major overweight, both at the defensive end, big names like Merck or Amgen, and United Healthcare, as well as speculative securities. I would just own the XBI, which is the biotech ETF that captures a broad swath of small and mid-cap companies that are on the mend.